Objective 7.1, laws affecting employees' pay deductions and employers' payroll taxes. There are two primary reasons you need to maintain accurate payroll records. First, we must collect the data necessary to compute the compensation for each employee by payroll period. Second, we must provide the information needed to complete the various government reports, federal and state, required of all employers. All business enterprises, both large and small, are required by law to 1. Withhold certain amounts from employees paid for taxes, 2. Make payments to the government agencies by specific deadlines, and 3. Submit reports on official forms. Because governments impose penalties if the requirements are not met, employers are vitally concerned with payroll accounting. The employer is required to keep records of the following information: personal data on the employee, name, address, social security number, and date of birth. 2. Data on wage payments, dates, amounts of payments, and payroll periods. 3. Amount of taxable wages paid, dates and amount earned year to date for the calendar year involved. And 4. The amount of tax withheld from each employee's earnings by pay period. Many companies use software such as Excel, QuickBooks, QuickBooks Online, a cloud-based accounting application, or an outside payroll service such as ADP or Paychex to assist with their payroll accounting. Payroll accounting involves employee compensation, withholdings, records, reports, and taxes. Therefore, it's important to determine who is an employee and who is an independent contractor. An employee is one who is under the direction and control of the employer, such as a salesperson, an administrative assistant, a vice president, and a controller. Basically, right here, anybody that receives a paycheck from the employer is an employee. An independent contractor, however, is engaged for a definite job or service and may choose his or her own means of doing the work. Payments made to independent contractors are in the form of fees or charges. Basically, the company gets an invoice from the independent contractor, a bill to pay. Independent contractors submit bills or invoices for the work they do. The payment is not subject to withholding or payroll taxes by the person or firm paying the invoice. So if you have an independent contractor, you don't have to worry about reporting withholding or payroll taxes because they're not on your payroll. Such taxes are the responsibility of the independent contractor. Businesses are required, though, to give an independent contractor an IRS form for the year if the fees paid are $600 or more. Just an FYI. The IRS has published guidelines for employers to use in determining worker classification. If a worker is classified as an independent contractor and should be an employee, the IRS will impose substantial penalties on the employer. For more information about employee versus independent contractor status, go to the irs.gov. So an example of an independent contractor would include a plumber, a lawyer, or a CPA that offers his or her services to the public that a business would utilize. Both federal and state laws require the employer to act as a collecting agent and deduct specified amounts from employees' gross earnings. The employer sends the withholdings to the appropriate government agencies, along with reports substantiating the figures. Certain payroll taxes are also levied on the employer. These taxes are based on the total wages paid to employees. Let's look at some of the more important laws that pertain to payroll. The first one, the Fair Labor Standards Act of 1938, is referred to as the Act, or FLSA. The Act provides minimum standards for both wages and overtime. Also included in the Act are provisions related to child labor and equal pay for equal work. In addition, the Act exempts specified employees or groups of employees from some of its provisions. Some details of the Act can be found at opm.gov. So, learning objective 1, recognize the role of income tax laws that affect payroll deductions and contributions. Here's another law, Federal Income Withholding Tax. The Current Tax Payment Act, passed in 1943, requires employers not only to withhold the tax and pay it to the U.S. Treasury, but also to keep records of the names and addresses of the persons employed, their earnings, withholdings, and the amounts and dates of payment. The employer must submit reports to the Internal Revenue Service on a quarterly basis. So every 4 months or 3 months, 4 times a year. And to the employee on an annual basis. That's the W-2 that you get. As an employee, that's what you get. The employer has to print that off and get that to you. We will discuss these reports and related deposits in Chapter 8. So in the real world, many companies, especially small businesses such as this street cafe, outsource their payroll processing activities. According to Paychex Inc., a payroll and human resources company, businesses outsource their payroll to improve accuracy, to increase security, and to maintain compliance with tax laws and regulations. B. Thomas started Paychex in 1971 with just one employee and a $3,000 investment. In 1983, the company went public and is currently traded on the NASDAQ stock exchange. So just to make sure everybody's in the up and up, a lot of places just outsource it and have an independent contractor take care of their payroll. Small businesses do that. FICA taxes, employees share. The Social Security Act of 1935 began as an attempt to provide retired workers with benefits based on their work history. Several amendments have been added, for example, benefits for spouses and minor children of retired workers, disability insurance, an increase in the age as to when benefits may be collected, Medicare, and supplemental security income. Current FICA taxes consist of Social Security taxes and Medicare taxes. At the writing of this text, employees contribute 6.2% or .062 written as a decimal on the first $118,500 earned in a calendar year for Social Security. Employees contribute 1.45% on all earnings in a calendar year for Medicare, with no earnings limit. Throughout this chapter, this sounds confusing. It'll be easier later. You'll see. Throughout this chapter, we'll use these percentages and earnings limitations for our calculation. So an FYI, for employees who are paid wages in excess of $200,000, an additional 0.9% must be withheld. Employers do not have to match the additional Medicare withholding, just an FYI. FICA taxes the employer's share. FICA has two sides to it. The employee has to pay in and the employer has to pay in. As the writing of this text, the employer is required to match the amount of FICA taxes withheld from the employee's wages. The employer pays 6.2% on the first $118,500 earned by the employee for Social Security taxes, which was discussed earlier, and also matches the amount of Medicare taxes, 1.45% withheld from the employee's wages. The employer's share of these taxes is recorded under payroll tax expense. There's a new account for you. Every 3 months, the employer must submit reports to the U.S. Treasury using Form 941, which is the same form used to report income tax withheld. The employer's payment to the Internal Revenue Service, the IRS, consists of 1, the employee's share of FICA taxes, which was discussed previously, and 2, the employer's matching portion, which is discussed here, and 3, the employee's income tax withheld, which was discussed 2 slides ago. We will talk more about this in detail in Chapter 8. But certain employees, such as railroad workers and some teachers, may be exempt from FICA Social Security tax. Iowa does not have the exemption for teachers, but Illinois does, just an FYI. So states have different laws also. State unemployment taxes. Each state is responsible for paying its own unemployment compensation benefits. The revenue provided by state unemployment taxes is used exclusively for this purpose, for unemployment. However, there is considerable variation among the states concerning the tax rates and the amount of taxable income. This tax is paid by employers only. A few states, under their State Unemployment Tax Act, charge their employers a percentage on the first $7,000 an employee earns. This is similar to the taxable income stipulated by the Federal Unemployment Tax Act. However, most states have a much higher taxable wage base. As of the writing of this text, Washington State, with a taxable wage base of $44,000, is the highest. In this text, we will use 5.4% of the first $7,000. Most states require employers to file reports and payments on a quarterly or 3-month basis. Included in these reports are a listing of employees' names, Social Security numbers, amounts of wages paid to each employee, and computations of unemployment taxes. This is a lot to remember right now, but you can always come back in this book and revisit and reread this for full understanding. Federal Unemployment Tax Act. The purpose of the Federal Unemployment Tax Act is to financially support government-run employment offices, pay half of extended unemployment benefits when unemployment is high, and provide a fund that states can borrow from to pay benefits if needed. The Federal Unemployment Tax Act taxes are paid by employers only. Generally, this includes all employers except nonprofit schools and charities. The federal unemployment tax is based on the total earnings of each employee during the calendar year, January 1st through December 31st. For example, for the examples and problems in this text, we will use the current federal unemployment tax rate of 0.6% on the first $7,000 of each employee's earnings during the calendar year. Reports to the federal government must be submitted annually on Form 940. That'll be discussed in Chapter 8. Workers' compensation laws protect employees and their dependents against losses due to death or injury incurred on the job. Most states require employers to contribute to a state compensation insurance fund or to buy similar insurance from a private insurance company. The employer ordinarily pays the cost of the insurance premiums. The premium rates vary according to the degree of danger inherent in each job category and the employer's number of accidents. The employer must keep records of job descriptions and classification as well as claims of insured persons. The following table presents a summary of the various payroll taxes and identifies who is responsible for each one. Right here's what you have to keep track of with your employees that they have to pay out of their paycheck. This is what you have to pay regardless as the business owner. Employees may be paid salaries or wages depending on the type of work and the period of time covered. Money paid to a person for managerial or administrative services is usually called salary, and the time period covered is generally a month or a year. Money paid for skilled or unskilled labor is usually called wages, and the time period covered is hours or weeks. Wages may also be paid on a piecework basis or per unit basis, such as the number of boxes of strawberries picked. A company may also supplement an employee's salary or wage with other benefits, for example, commissions, bonuses, cost of living adjustments, and profit-sharing plans. As a rule, employees are paid by check or by direct deposit to their bank account. However, their compensation may also include amounts for items such as personal use of company automobiles, athletic club dues, or holiday gift cards. When compensation is in these forms, the employers must determine the fair value of the property or service given in payment for an employee's labor. For more information on which these are fringe benefits, are taxable, and how to value them, see Publication 15B, Employer's Tax Guide to Fringe Benefits, located on irs.gov.